Guys, today we're going to be talking about how to predict a trend. Now, this is probably one of the most powerful tools, regardless of if you're a trend trader or you're a mean reversion trader, because trends are obviously the ideal environment for a trend following system, which we'll mark out with a T. But also, trends are the worst environment for a mean reversion system. So, regardless of which one you go for these, which one of these you like doing, understanding how to identify trends and predict when they may start and when they may end is really the foundation for understanding, am I in the right environment right now, or am I going into the right environment for my strategy to work at its best? And this is really the issue that most people find because, if we take FX, for example, and we just zoom out a little bit on this chart, you'll see that most of the time we will be in this kind of choppy behavior. We will go through periods of, high price volatility, but we go through a lot of choppiness for, I would say, the majority of the time. However, when these big events do happen, what most people will do is they will rely 100% on the past. Now, this is a great start, but this is something that is massively lacking in this industry in terms of teaching. Because if you just rely on the past, you're never really going to be able to tell what is about to happen. You can get slight edges and things like this, and that's fine. But the problem is that you're always basing your decisions based off the past. Now, let's just go into a specific example. Why do price moves like this actually happen in the first place? Well, in order to understand that, we need to understand what the purpose of the FX markets are, right? At a basic level. So, really, the goal of the FX markets is price stability. Okay. We don't naturally, FX markets don't want to trend. But the reason that they will trend is because of new information coming out. And there are two layers, which makes everything a little bit more tricky. We have the fact, but then on top of the fact, we also have the reaction. So you've kind of got to get two things right in order to fully understand how to kind of predict trends. So what does this mean? Well, let's just say a new piece of information, so a new fact comes out. That's great. But to be honest with you, you don't know what that reaction is going to be. So you could have some what looks like really positive information coming out about a country or whatever, but it could have a negative reaction. It could be positive and have a positive reaction. And so you get into this issue of like trying to predict two things at the same time. And it's very difficult because, the economies of the world are very, very complex things, right? So instead of trying to detect the reaction, and by reaction, we normally define that as prices either going up or down, which we will just represent, so I'll just draw it out as direction. Instead of trying to pick direction, what if we just picked the environment? Meaning, our reaction, instead of us going, okay, need to figure out whether prices are going to go up or down. What if we, instead of this, said, okay, let me just estimate what type of environment we're going into? And there are really only two main types of environments. We've got low volatility. So this will be kind of consolidation type scenarios, or we have high volatility, which is going to be trend type scenarios. So an easy example, what this arrow is pointing to, this aggressive price move, this is high volatility, and then an area of low volatility would be something like this, right? So why the hell is this important? Well, because when we're trying to predict a trend, what we're really trying to do is we're trying to predict high volatility. And predicting high volatility just comes from understanding, why would volatility be higher or lower at a certain point? Well, if we have really high volatility, then what the market's purpose is they are pricing in expectations of the future, the value of that particular currency versus another currency. And so, in order to have a big, sharp move, something has to change. There is going to be a catalyst. This does not just happen randomly, there is a reason. Now, you may not always know exactly what this reason is. You may not even know what the direction is. But if you can just predict, look, I just think that we're going to be exiting out of a consolidation phase, then don't you think that that would be the basis to begin building or adding to an existing strategy and giving you a bit of an edge? Like, for example, if our strategy works really well in consolidations, but then doesn't work so well during trends, and we have the ability to go, look, I think it's a really high probability that regardless of if we go up or down, we're going to go into a phase now where we're in very high volatility, which I know is bad for my system, then wouldn't it make more sense to just ignore any signals that we might get until that volatility has died down? That alone is it can be the difference between a losing system and a highly profitable system just from that alone. Because what most people will do is they will get to a point like this, let's just say here, and then they will just keep trading the system, keep trading, and then eventually what will happen is they'll run into an environment where their system doesn't perform very well. Maybe they start as a trend trader, and this environment right here that we see is all really perfect, and we're trading it all the way down. They make loads of money, but then they give it all back in here because they had no way of predicting, which environment is best for the system. They'll get chopped around here, chopped around, and they'll give back all of their gains. And then what they'll start doing is they'll start going back and re-back testing and trying to make it all work together. But the problem is that the past, whilst it's a great tool, it's a great beginning start to gain an edge. It's really limited because at the end of the day, the markets are pricing themselves in based on future expectations. And so being able to understand where that volatility might come from is really, really a golden skill, and also takes the stress of needing to pick a direction necessarily, because all you're really doing volatility is you're estimating what the environment you're going into is. If you have a mean reversion system, you want to avoid high volatility scenarios like the plague, and vice versa. If you've got a trend following system, you want to avoid periods of low volatility like the plague. So I hear what you're now thinking. You're thinking, Sam, this is great, but how do I actually go ahead and forecast volatility? Now, this will depend on what asset you trade. If you're trading indexes, indices, something else, gold, there are going to be different things that impact it. Euro USD is probably my favorite to read this sort of stuff from. And I've mentioned it many times before. You do not have to be an expert in fundamentals. You've just got to know a couple of things. The big daddy of volatility is anything to do with the central bank. So speeches, anything like this. You don't even need to necessarily watch them. You just need to understand that around these points, volatility increases massively. And then the second category is going to be employment data. And then the third is basically going to be anything else with an emphasis on surprise. So central bank, anything central bank, whether it's speeches, FOMC minutes, the ECB press conferences, if you see anything like that showing up, then typically expect volatility to increase, 1 to 2 days before, 1 to 2 days after. Employment data and anything else, even basically these other two categories here, the impact that these are going to have is going to depend on whether it's a surprise or not. Because if you pick out any of these, we always have the actual and we have the forecast. If the actual is really similar to the forecast, then it's already been priced in. You can see here as a classic example, prices didn't really react massively to this news. Why? Because it's basically as expected. The market is only pricing in new information. This is why another reason why central bank announcements are so volatile is because they say stuff that just is unexpected. They have such a huge influence on the market. And so surprises are very, very common there. Employment data, sometimes, so NFP, things like this, sometimes it will have a big impact, and sometimes it will not. It always comes down to how big of a surprise. The bigger the surprises, meaning the bigger the difference between the actual and the forecast, then the greater the volatility is going to be in the market, right? Final thing, anything else? So there's going to be all the other news events that you will see, right? Everyone likes to pick high impact news events like they are, God's gift to the planet. But at the end of the day, they're only really that important if they're a big enough surprise. Now, I'm trying to define, what is a surprise. There's lots of scientific data on this, but it's a very nuanced topic. At the end of the day, just understand that anything besides basically the central bank stuff and occasionally NFP, if it's a big surprise, it won't have anywhere near the same reaction that a central bank announcement will have on average. And so that alone is enough to be, just as probabilities go, to be like, okay, most of the time I know that this is going to happen. Most of the time I know around central bank announcements, there's going to be increased volatility. Now, in plain English, that means that there's more likely to be a trending environment around here. So that's either going to be a good thing if you're a trend trader, or it's going to be a bad thing if you're a mean reversion trader. But really just understanding this is so critical. And the rabbit hole does go quite a lot deeper on this if you want to get really, really good at it. I actually released a video in the Discord recently to explain how I go through this process and whatnot. But this should give you a decent place to start. It's a nice way to get involved in things and have a beginning to understand a little bit of future forecasting rather than just looking back in the past. the past is helpful. Unfortunately, it is very, very limited. This is why I have a bit of an issue with people who seem to think that trading is some sort of like technical analysis mastery. Technical analysis is mainly valuable as a risk management tool and gaining a very, very slight edge, right? But really, when you begin adding in all these other things, you begin to see how much more price can actually give you, how much more relaxing it can be. Because you feel an element that you not necessarily have some control over the market, but you definitely feel like you have something to offer. And so yeah, so I hope that that has helped, guys. I appreciate you leaving a like, and if you'd like to join the Discord, then I'll leave links for that in the description box below. But yeah, hope you have an amazing rest of your day, and I'll see you in the next one. Take care.